So in today's video, I'm going to give you a full guide on over 30 tax write-offs and tax strategies that will save your business thousands of dollars. I'm a certified public accountant and the owner of a tax strategy company that saves businesses thousands of dollars every year. My company and I help businesses all over the United States deploy tax saving strategies and write-offs. Now, the problem with both write-offs and tax strategies is that there's too much misinformation out there on what you can and cannot do, leading business owners to either overpay in taxes or follow the reckless advice that quite often leads to difficult IRS conversations or worse, penalties. Well, today, not only will we be breaking down all the write-offs and tax strategies you can use, but I'll also go through the conditions for them to work so that you can make sure that you're using them correctly. Let's dive into the video. First off, I kind of want to set the scene and talk about this concept of pre-tax versus after-tax spending. And this concept stems from, first off, pre-tax spending is money that is spent prior to it being taxed, and after-tax spending is money that's spent after the money has been taxed. And so the best example I can give from this is if you're a W-2 earner, you get your wages from your paycheck, and all these taxes are taken out, and then whatever's left over is your take-home pay. And any spending that you do with take-home pay is dollars is considered after-tax spending because it's dollars that's already been taxed. You're doing the spending after your money's been taxed. But as a business owner, we have our sales or our revenue, and then we have all these expenses that go into it, and whatever is left over is our profit, and that is what we get taxed on. We get taxed on the profit of our business. So any spending that we do within our business prior to that profit number is considered pre-tax spending. It's spending done prior to those funds being taxed. And so our goal as a business owner should always be, how do we turn after-tax spending we're going to do either way, into pre-tax spending? So our goal should not be, how can I go out and buy all these different things that I don't need in my business just to get a tax deduction? That shouldn't be our goal. And if your accountant's telling you that, I hope they change the tune. Our goal should instead say is, let's look at the spending that we're already doing. And is there a way that we can find a business purpose and move this from after-tax spending into pre-tax spending? And that is sort of this root cause or this root idea around small business tax savings and how we do these types of things. Now, in order for an expense to be an allowable business expense, it has to meet two things. The IRS has to meet two things. It's ordinary and necessary. Ordinary just means that the expense is common and accepted in your line of business, in your industry, in the type of company that you have. And necessary just means that it's helpful and appropriate to your business. This might be helpful to get employees. This might be helpful to retain employees. This might be helpful to get clients, to keep clients, to grow your business, whatever it might be. So in order for an expense to be an allowable business expense, it's got to be both ordinary, common and accepted, and necessary, helpful, or appropriate to your business. If we can check those boxes, it likely we're going down a road of how can we make this a deductible business expense. And so a lot about what we're going to be talking about today is this exact concept of after-tax versus pre-tax spending. How do we find the deductions that are available to us? How do we understand those strategies, and how do we implement them correctly, and how do we use this ordinary and necessary to back that up? Now, when it comes to tax strategies, I want to make it very clear that the government, most tax strategies that you see are there because the government wants you to utilize them. The government is incentivizing you to do something. I'll go for an example. Those that invest in real estate have a really good advantage from the government. The government wants people to build rental properties. The government wants new housing. They want places for Americans to stay and to be able to lay their head down at night. And so they're going to incentivize people to create housing, to have rental real estate. That's the government's job. And the same thing with a business owner. The government wants more and more business owners. It helps the economy. It helps support the country. As a business owner, you are hiring employees. You're boosting the economy. You're creating this economy that we create. And so the government loves business owners. And so what do they do for that? They give you incentives. And that's a lot of what we're going to be talking about today. What are the incentives that the government gives us? What do you need to know about them? And how do we implement them? Because the thing that we see so often is that the IRS does not come and say, hey, we gave you this incentive, but you didn't take advantage of it. So we're just going to assume we're going to give you some tax benefit for it. The government doesn't come knocking and let you know when you missed out on an incentive that they gave you. The government lists out the incentive. The IRS says, here are the incentives. Here are the opportunities that you get as being a business owner. It's your responsibility to learn them, understand what's available to you, and correctly implement them. And so that is what my goal here is today, is to help you along that process. So let's dive into the strategies, the write-offs, the different things. The first place I always like to start is your entity structure, your setup, your business entity, because this is the foundation of your business. You know, when you start a business, the way the entity, the way your business is structured, that's your foundation. That's your starting point. That is what you're building everything off of. And so it's important as a business owner to have an entity structure that makes sense for us and makes sense for your specific business. Now, when we talk about entity structures, we can operate as a sole proprietorship, and that's just simply we're opening up a bank account, we're operating as a sole proprietorship. There's no physical structure at the state level. It's just sole proprietorship, full liability. Now, the problem with that is that in the event of a legal situation, you are fully liable. There is no protection there. The next option for an entity structure is an LLC. And then the third option is a C corporation or some variation of those. And so most business owners we see line into, they open up an LLC or they open up a corporation. Most relatively, small business owners, when we think of small business owners, are going to be in that LLC route when they're opening up their business entity. So the entity structure is important that you have the right one, because that's going to be the foundation. That's what you build your business off of. Now, you might be just starting out. And I always say, where are you at in this process? If you are just starting out, you don't even know what your business is going to be, but you know that you want to be an entrepreneur, we might not need an entity structure yet. But as soon as we start that business, that is where we say, let's get an entity structure set up. And so I always give this example. I'm a golfer. And so I often give this example of saying, okay, let's imagine you're a golfer and you're like, I want to create this really fancy, cool tool that's just going to change the life of golfers. And that's my business. Well, that is not a business. This fancy tool that's going to change the life of a golfer, that doesn't tell us anything. Now, if I instead said, I've created a prototype of a golf ball that can withstand 10,000 hits. If you lose it in the woods, it will emit a sound that you can find it. And if you goes in the water, it'll float. Now, this doesn't exist and it probably never will, but I'm just giving you an example. But I have a prototype and I'm going to take it to the market. Now, that's much more of a business than saying, I'm going to create this fancy device that is going to change lives, because there's no details to that. So that fancy device that's going to change lives probably isn't ready for an entity structure. Let's find out what that device is. And we say, okay, now I have a prototype. Now I want to bring it to market. Now I want to start getting investors or whatever it might be. Now we want to get that entity structure set up. Now, some of the mistakes that we see is first off, we need to determine, okay, what entity structure is right. For most small business owners, we're seeing them organized as an LLC to get started. LLC versus a sole proprietorship. Remember, a sole proprietorship is nothing. No entity structure. You're just operating as a sole proprietorship. And from going from a sole proprietorship to an LLC, there is no tax benefits there. They're taxed exactly the same way. But as an LLC, not only will an attorney tell you get some legal protection from it, but it also sets up and opens up the door for a strategy that we're going to be talking about later, which is an S corporation. So the first thing we want to do is find out, okay, where are we at in this business stage? Are we actually in a business? Okay, let's get an entity structure set up. Let's determine which one's set up, correct, which one's the one we need, get our EIN, open our bank account, do all those things. Now, the mistake that we see people make is they just hit the ground running. And we understand, as a business owner, you need to start generating income. And if you don't have you just need to go out and start your business. And so you don't have time to dot your I's, cross your T's, make sure you have the right entity structure set up. So you just hit the ground running. And the mistake that we see with that is people are in entity structures that don't make sense for them. People are in entity structures that provide them no protection or the wrong protection. People are in entity structures that they didn't set up correctly, so the protection it was supposed to serve isn't doing anything. Or people are in entity structures that are making them pay more in taxes than they're supposed to. And that's why it's important to make sure we have a solid entity structure set up as our foundation. Now, if you're listening to this and you've kind of been that fly, going off the whim, just hitting the ground running, take some time now to go back, put that foundation in place, and then continue what you're doing. So the next step is, once we have that entity structure set up, we want to look at a strategy that we call the S corporation. Now, the S corporation is a way to help minimize the amount that we pay in self-employment taxes. So if you're set up as a sole proprietorship or a single member LLC, you're going to pay self-employment taxes on 100% of your income. So self-employment taxes are 15%. your business makes $100,000 in profit, you're going to pay self-employment taxes of 15% or $15,000, 15.3% exactly. So $100,000 in income, profit from your business, you pay self-employment taxes of $15,000. That is if you are organized as a sole proprietorship or a single member LLC. Now, an S corporation comes into play because with an S corporation, an S corporation is simply a tax election. We're electing for your entity to, instead of being taxed as a single member LLC or a C corp, we're electing for it to be taxed as an S corporation. And with an S corporation, we come in and we split your income into two pieces. So instead of that $100,000, we're going to split it into two pieces: a salary piece and a dividend or distribution or owner's draw piece. In that salary piece, you're required to take a reasonable salary for the work that you're doing for your entity. That salary piece is going to get hit with self-employment taxes. Now, they don't call it self-employment taxes, but the number adds up to the same exact thing. So that salary piece gets hit with self-employment taxes, but any income over and above that salary, you avoid self-employment taxes on. So when we look at this, let's go to that example. You're making $100,000 in tax, or $100,000 in profit from your business. If you're set a sole proprietorship single member LLC, you're going to pay $15,000 in self-employment taxes. Now let's just use an example. Let's just say of that $100,000, we said a reasonable salary was $50,000, half of it. Now that might be high, that might be low, but let's just use that as an example. So that $100,000, we're now going to take $50,000 as a reasonable salary in our business. We're going to pay self-employment taxes on that, roughly $7,500, but we're avoiding it on the remaining $50,000, the amount that we did not take as an owner's salary, and instead just took as an owner's draw or distribution. So in that scenario, instead of paying $15,000 in taxes, in self-employment taxes, this is over and above your normal income tax rate, by the way. Instead of paying $15,000, now we're only paying $7,500. So that's some massive tax savings there. Now, the downfall of an S corporation is that you have to pay a reasonable salary, so you have to have a payroll company to manage that salary for you. And the second downfall is it's a little bit more of a complex tax return, which could cost some money to prepare and file that tax return. So those are two costs that you would not have if you were a single member LLC that you do now have with an S corporation. And so for those reasons, we typically say once your business hits profit of about $50,000 or so per year, that's when you want to start looking into electing S corp status. Now, I specifically did entity structure as the first point because in order to have an S corporation, you need to have an LLC or a C corp. And then you're electing for that LLC or C corp to be taxed as an S corporation. So if you're operating as a sole proprietorship, you don't even have the option of an S corporation. And that's where having that foundation is important, because if we have that foundation of an LLC set up, now we've been operating our business, maybe at a loss for the first 2 years, but now we're becoming profitable. And now we're hitting that $50,000 in profit mark. And now we're going to want to look into that S corporation. Well, guess what? We have that LLC set up. We can elect for that LLC to be taxed as an S corporation, and we go ahead and transition the entity to that to start that self-employment tax savings. That's the power of an S corporation, is to minimize the amount that we're paying in self-employment taxes. Now, a lot of people make mistakes here because they're not taking the right salary. They're maybe not have the right entity structure set up. They might be operating as a sole proprietorship. Now, the key thing about this is if you're not taking the right salary, the IRS can come back and move some of the distributions or draws you took into a salary and back taxes and penalties and everything else on that. And so a lot of people say, well, Mike, why wouldn't I just take $1,000 salary? I'm making $100,000. Why wouldn't I just take $1,000 salary? Then I'm paying $150 in self-employment taxes, and I just saved $15,000. And I say, well, in theory, that would be great. But the IRS requires you to take a reasonable salary. And $1,000 on $100,000 of income likely is not going to be reasonable. And that's why we need to make sure that we're dotting our I's, crossing our T's. When we implement the strategy, we need to make sure we're doing it correctly, and we're making sure that everything is lining up correctly for that as well. So that's this idea of both entity structure, and then maybe when time is right, $50,000 or more profit, we may be looking at an S corporation. Now, the next item I want to talk about is this concept or idea of maximizing deductions. And this goes back to that idea of after-tax versus pre-tax spending. And I always say when we're looking at a business owner, do not forget about obvious business expenses. Much of the stuff we're going to be talking about today is sort of things where it's getting your ideas, getting things flowing to try to encourage you to think of different ways that you can save the most in taxes. But don't forget about the obvious ones. I had a friend of mine that started a business, and a photography business, and they went and bought a new camera. They were paying for some software to do some editing of the videos and all these different things. And they came to me and they're like, Mike, you can't take a deduction for this, right? This camera, the software. And I said, absolutely. That is part of running your business. Anything that's part of running your business is going to be deductible in some sort of way. And so don't forget about obvious ones. If you are paying a software to run your business, that's a valid business deduction. And so we're going to start breaking down different items in this idea of maximizing deductions, but don't forget about the obvious ones. So the first one that we want to talk about is advertising. So advertising is just things that help promote your business. Think of things like billboards, TV commercials, media buys, radio ads, flyers, postcards, or business cards. All those different things are different types of advertising. Again, as a business owner, you're looking to grow your business, and you have to spend money to grow your business oftentimes. And anything you do in that form of growing your business is a form of advertising. And that's what advertising is. Now, why is advertising allowed? Because the government wants you to grow your business. As your business grows, you're hiring more employees. As you're hiring more employees, that's getting less people off unemployment. As your business grows, you're building your business, more people are buying, the economy's growing. That is all great things. So that is why the government incentivizes you to do advertising. Now, some of the cool things that we really like about advertising, how can we, some planning opportunities with advertising, is this idea of sponsoring. So a lot of businesses, a lot of people support local charities in different ways, and they treat it as a charitable contribution. But in a way, we could get a better benefit from it if we treat it as advertising instead of a charitable contribution. I'll give you an example. Let's say that you wanted to support your local baseball team, and you give them a check for $1,000. You might think, well, that's a charitable contribution because I'm supporting a youth baseball league. Where instead of making a charitable contribution, couldn't you say, well, I'm going to buy all the uniforms, and I'm going to put my logo on the shirt, or I'm going to put a banner out in the outfield, or I'm going to do these different things. Well, now that's advertising. That's no longer a charitable contribution. Now that's an advertising expense. So it's a great way to move something from a charitable contribution into advertising, sponsoring. Same thing with golf hole events. A lot of people say, well, the local charity is running a golf outing, and I just wanted to give money to that charity. So I'm going to go send that charity $10,000. Or instead, could you sponsor a hole in the golf outing that they do every year and pay that $10,000 to sponsor that hole? And now it's an advertising expense. So those are ways that we can boost up our advertising expense and move something from a charitable contribution into an advertising aspect. The other thing is clothing. Traditionally, clothing is not a deductible expense for you or your business. You go out and buy a new pair of pants and a t-shirt and a quarter zip that you're wearing around. That's not a deductible expense. Even if you wear that quarter zip in your videos, that's not a deductible expense. But if you take that quarter zip and you put your logo on it, now we can look at it as advertising. Now it may be a deductible expense. So we want to get creative in the ways that we're thinking about those different things. The next expense or write-off that I want to talk about is contract labor. Contract labor is when you're paying people to do work for you that are not employees. So think of something like you have a freelance graphic designer. You have someone do landscaping for you. You have somebody that's going to come in and paint the walls in your business. You have somebody that's doing some virtual assistant type work for you. You have someone that's doing marketing for your business. Those are things like contract labor. And it's someone that you're just paying on a contract type basis to come in and do work for your business. The government loves this because, again, every contractor you pay is another person that you're supporting in your business. Now, the biggest thing with contractors is we want to make sure that we're grabbing a W-9 from them, because at the end of the year, you're going to have to send a 1099 to any contractor that you paid throughout the year. And in order to get the information that you need to send a 1099, you grab that from a Form W-9. And so if you paid any contractor over $600 in total throughout the year, you're going to have to send them a 1099 at year end. So we always recommend that the first time you pay someone, even if it's under that $600 mark, always grab a W-9 from them so that you have that information on file should you need it when it's time to send that 1099 to them. The next expense item I want to talk about is equipment and furniture. So that desk that you put into your office, that chair, that TV, that desktop monitor, the lights that you put in, that camera, those types of things, equipment and furniture you buy for your business is a deductible business expense. Again, these are things that help your business succeed. You don't want to be working on the floor in your home office on a laptop. You want to be on a desk. You want to have a chair. Those are valid business deductions that we want to think of. So we look at the desk, the chair, lights, tables, TV screens, microphones. I'm looking around. Everything around here is a deductible business expense that helps your business succeed. The next thing we want to talk about is gifts. So if you give gifts to, whether it be clients, employees, different things like that, you're limited to $25 per person per year as a valid business deduction. So you're a realtor, someone closes on their business, a house, you buy them a bottle of wine, you're limited to $25 per gift that you give that person. Now, this is a great opportunity, again, to just show your respect, show your support, and say, hey, thanks for supporting me as a business owner. I want to give a gift to you. Great opportunity. But that $25 has been $25 for a while and is a little low. We want to sometimes be like, what's a $25 gift nowadays? So we want to think of ways of how can we bump that up a little bit. And so some of the strategies I like to go through first, if you're married, it's $25 per person. So if you have a couple, you could do $50 for that couple. The other thing that I like to do, and this is just kind of a form of different categorization, is let's imagine that you want to give your employees iPads for Christmas. Now, obviously, that's going to be way over $25. So how do we make that work? Well, what if you preloaded those iPads with their email on it? You preloaded it with some training materials, different things, and you kind of say, okay, this is your new device for the office, and and then you give that to them as a gift or as a new work device for them. Not a gift, but a new work device. That's the form of changing the categorization. So now you're not giving them a gift of an iPad. You're giving them an iPad to help them be better at work, to help them learn the different training that you have on there, to help them be more efficient at work. So that's what I call different categorization. And then another one is if you put your brand, if you put your logo on it. So think of things like pencils, paper pads, different things like that you have your logo on. Those would obviously be business expenses as well, not really kind of categorized in that gift category. The next expense I want to talk about is office expenses and also technology. And so office expenses are think of things like all the supplies that you have around your office, those different things, pens, papers. Technology might be iPads, microphones, cameras, lights, earbuds, your phone, all those different things. All these are valid and related to your business, assuming you're using them in your business. And a big thing that the IRS says is they want to make sure that, let's say you buy a new camera for your business, and right now I'm filming you from a camera, and so this is a great example of it. Now, this camera is 100% business write-off because I am using this for my business. And so technology, I say, oftentimes it'd be very hard to find a piece of technology that you say has nothing to do with my business. These new Apple AirPods. Those are definitely business related. The iPhone that I use, I do business on my iPhone. Again, this microphone that I'm talking to, that's business related. So I often say, oftentimes anything you buy at Best Buy, Walmart, those types of things that are technology related, oftentimes we'll have a business purpose for them. We want to make sure that we're tracking that, maximizing it. As we're swiping our card, think of, is there a business purpose for us? If so, let's take advantage of it. Now, another write-off that we want to talk about is rent. So think of things like renting a office space, renting maybe a storage unit, doing a rental on a short-term thing that you're doing with a retreat or a location that you're hosting an event at, or different things like that. These are all valid business deductions. Again, software. Software is an incredible piece. The business day we're in with AI and all these different things, software runs their day. Not many businesses I know that I've talked to have no piece of software that they use to run their day. That software could be payroll software, time tracking software. That could be a project management system, maybe a chat system internally or externally. Maybe it's a software that you utilize to provide your service. Maybe it's a PDF type software. Maybe it's any kind of software like that is valid business deduction. Again, this is one thing that I don't want people to miss out on. Think to yourself, is this part of running my business? If so, then it's a valid business deduction. Is it ordinary and necessary for my business? If so, let's count that. The next thing we want to talk about is utilities. So think of telephone, internet, maybe TV service, depending on where you are. If you own a dental office, you have TV playing in your office. That's a valid business deduction. We want to be making sure we take advantage of those. So those are some of the write-offs that I like to encourage people to think about, that we want to kind of run down and run through. Now, there's all the different things like bank charges and merchant account fees, maybe workshops and trainings that you're doing, maybe dues that you're paying to organizations, professional organizations, maybe Costco memberships for all the business supplies that you buy at Costco. Maybe it's subscriptions to newspapers or various different things you have located around your office, or maybe it's postal or shipping costs or various different things like that. These are, of course, all valid business deductions. And again, don't forget the obvious ones. Be strategic. When you're swiping your card, think of, is there a way that I can find a business purpose for this? If so, let's take the business deduction. Let's take the pre-tax deduction for it, run it through the business, and get a deduction for it. I always say, review your personal statements. Look at the spending that you've done personally, and is there business-related items on here that we can recategorize, utilize in our business? And that's this idea of write-offs. How do we maximize deductions? How do we move after-tax spending into pre-tax spending? Not go out and buy something that I don't need for my business just for a tax deduction. That doesn't make sense. If I need it for my business, great. Let's go out and buy it. But let's not go buy things that we don't need just for a tax deduction. The next thing I want to talk about, and the next tax strategy that we're going to be talking about, is an accountable plan. Now, an accountable plan is to reimburse yourself from the business for items that you paid for personally that were business related. And an accountable plan is a very powerful tool that you want to have in your back pocket. Again, an accountable plan is something that you use to reimburse yourself for business related items that you paid for personally. Now, these could be items that you just accidentally swiped the wrong card. You need to reimburse for that, obviously. But more likely than not, we use the accountable plan for items that are business and personal mix. So think of a home office, maybe an automobile, maybe cell phone, where you have business and personal mix, and you need to reimburse for the business portion. So that's what an accountable plan is. When does it make sense for an accountable plan? Anyone that's organized in an S corporation should have an accountable plan put in place. And there's a couple things that we need to do with an accountable plan. First off, we need to have a written document that we have on file. And that document's going to outline, how does this accountable plan work? What are we reimbursing for? How often are we doing it? And we need to have that written out and on file, signed, and put into the corporate documents. The next thing we do is we need to make sure that we have some type of tracking sheet to recognize when we're going to reimburse for that and what that reimbursement is. So, we might have within TaxOn, we have a tracking sheet that shows, okay, here are all the items you're getting reimbursed for. We put it on record. If the IRS comes knocking, we have the proof for that. Now, the biggest mistake that we see people make with accountable plans is they pay for something personally, and then they just send money from the business, or they just run these things through the business when they aren't business related 100%. The biggest mistake that we see is that when you pay for something, when you just make a reimbursement without any kind of accountable plan in place, the IRS could disallow that. If the IRS comes knocking and you don't have an accountable plan in place, they could say that is not an allowable expense. And that's why it's so important to have that documentation on file and making sure that you're following it by the rules. We also don't want to commingle things. So those people are saying, well, I'm just going to run everything through the business and then I'll kind of piece it out later. Well, the problem with that is the IRS, first off, if they see everything commingled, they will challenge so much of your items, so much of your activity. Even the obvious ones, they will challenge because everything's kind of commingled into one. So we don't want to do commingling. We don't want to be doing reimbursements without an accountable plan in place. We just want to make sure that we have that document in place. Then we go ahead. It's a business deduction, tax-free to us as the business owner. So accountable plans can be very beneficial in our business. The next tax strategy I want to talk about is the home office. Now, the home office is for use, a location in the home that you as the business owner are using to work out of. Now, home office, a key part here is it's got to be exclusive to the business. So if you are operating off of running your business in your home office, which is your dining room table, that you also eat dinner on, and that you also have, friends and family come over and play card games on, that's not going to be allowed because it's not exclusively used for your business. So home office needs to be an area, a location, a section that is used exclusively for your business. And when we have a home office, we have a couple different options. We can take the standard home office deduction, which is just $5 per square foot up to a maximum. Or we can do the actual, where we calculate all these expenses that go into our home. So think of utilities, mortgage interest, real estate taxes, all these different expenses. And then we take the business use percentage. So if the home office is 200 square feet and our home is 1,000 square feet, that means that 20%, 200 divided by 1,000, is related to our business. And so there's two different routes that you can go down to that. Now, I think every business owner should have a home office. Even if you have a secondary office, let's say you're a dentist and you have a dentist office, you can still have a home office, because there's a clause that the IRS put in place that says if you have an administrative office, it can count as a secondary location that can be in your home. Now, administrative office just means that you do your administrative duties in that home office. So let's say you're a dentist and you have a regular office that you treat your patients at. That's, of course, fully deductible. But then you come home and you do billing, invoices, emailing outside of that administrative office. Well, now you have a home office and you also have another office. So I truly believe that every business owner should have a home office of some sort. Now, there's a lot of people out there that say, Mike, I'm not going to do the home office because it's risky. First off, I want to say the home office is not risky. This is black and white in the IRS code, and the IRS talks about it all the time. But what is risky is some of the mistakes that people make. They'll say that 90% of their home is related to their home office. That's clearly going to be really hard to do. Those are the people, when you read things online of, hey, this person got busted for this, or this person has to pay all his taxes and penalties for this, it's because of abuse. They're not utilizing the strategy the right way. They're getting greedy. They're taking more than what is actually allowed. As long as you are following the law by the books, dotting your I's, crossing your T's, doing things the right way, there's nothing wrong with the home office. And we see every business owner that comes through tax sale utilizing the home office in some sort of way, whether it's the full actual type deduction or we're just doing the standard home office method. Whatever it is, we are finding a way to make a home office deduction in every small business owner in some sort of way, whether it's the main office, administrative office, something like that. The next thing I want to talk about is setting up a board. Now, a board can be extremely valuable in your business for many different reasons. So a board is just basically saying, here is people that I'm close to that I want advice. I want them to give advice on my business. So a board could be something like, we're going to hold monthly board meetings, quarterly board meetings. We're just going to do an annual board meeting, whatever it is. And based on your business, every business should have a board. Even if you are a solopreneur, you should have a board. And why? You should have a board because it's going to help you in so many different ways. One, it's an outside perspective. As business owners, we are so deep in the weeds of our business, and we're constantly, working on our business. We don't ever really get to step away. Also, we see things one way that an outsider might see a completely different way. And that perspective that they bring to the table can be extremely valuable to us. It also, a board can help keep us accountable. If we say, well, I'm going to start this marketing campaign next month, I tell my board that at our board meeting. If next month comes and that's not done, it keeps me accountable. It keeps somebody on watch for me, especially as I'm the business owner, I'm the boss. If I say I'm going to do something and I don't do it, guess what? Who cares? Because I'm the boss. But if I have a board, I got to report to you. Now I'm going to make sure that I'm completing these things that I am making that I think is important to our business. So a board can be so valuable to helping you and your business succeed. Now, who is on the board? Oftentimes we're seeing family, friends, close people, basically anyone that can really bring some advice to your business, whether that's an advisor, that can be a friend, that can be a family member, whatever it is. Now, a board provides many different benefits, not just the benefit of everything I just talked about, that outsider perspective, that advice, that accountability. But a board also is a tax saving tool, because guess what? When you have board meetings, that's an expense. The meals at that board meetings, an expense. Maybe you do an annual board meeting where you travel for that business, that board meeting. Well, that's an expense. And if you decide to, if your family's on your board and you decide to go travel for your annual board meeting, you go them and you want to bring your board members, well, the travel for your board members is allowed too. So the board can be a great tax benefit outside of all the other great benefits involved in it. Now, the biggest mistake and some of the things that we see business owners make when setting up a board is, one, they're not actually holding these board meetings, or they're not utilizing it. They just say, oh yeah, I have a board, but then they never do anything with it. They let it sit there. The other thing is they get greedy. They try to take, they fly to every month they do a board meeting, they're flying their family and everybody all over the place. Well, might be excessive for a one-man shop that's making $100,000. Now, if you have a multi-million-dollar business and your growth all over, there might be some validity for that. So just think about your situation and make sure you're not getting greedy. Make sure you're doing your things the correct way. Make sure you have the documentation. A lot of people will say, I had a board meeting, but there's no documentation to support that. Where's your board meeting minutes that shows you had your board meeting? What was discussed? What are we following up on? So utilize this as an actual strategy to help you and your business while also saving taxes at the same time. The next tax strategy I want to talk about is the 14-day home rental rule, or the Augusta rule. And this is this idea of, if you rent out your home for 14 days or less, you pay no income taxes on it. If you rent out your primary residence for a total of 14 days throughout the year or less, you don't have to pay income taxes on that income that you receive for that rental. So if you're in a location that's having a Super Bowl or a golf tournament or something like that, and you have a bunch of people coming in, your home can be really valuable. You can make a good chunk of change, without having to pay any taxes on that. But not all of us are in that situation. And so we say, how can we utilize this board to maybe utilize the 14-day home rental rule? How could we rent out our home to our business, get a business deduction for that rental, and pay no income taxes on that income that we receive for it? And oftentimes we do this with a board. We hold a monthly board meeting. Instead of going in, renting out a boardroom or renting out this area, we do it at our house. We bring our board members in, we host that meeting at our house, and we utilize the 14-day home rental rule to get a business expense, and we pay no income tax on that income as long as our total rental days across all activities for our personal residence was 14 days or less. Now, what businesses do we see this doing? Mostly, first off, you have to have a separate business entity for this to work. And so as corporations, we see this often. But some of the things that we see mistakes is that they don't have a valid rental reason. They're just having this home with no true rental reason. The other mistakes we see is there's no documentation or support of the rate that they're using to reimburse it. So as you're making this rental payment, you need some type of benefit. You can't just say, well, we're just going to charge $10,000 a day, and I'm going to rent out my day 12 days a month or 12 days a year, and that's going to be a $120,000 deduction. Oh, yeah, IRS is going to say, where are you getting that $10,000 a day number? I don't know. That's what I think would be fair. No, we need to have true documentation. So what does a boardroom cost to rent down the road from you? What does a boardroom in a local co-working space or a local hotel cost? Let's use that as our reimbursement amount. Let's have a rental agreement in place. So let's dot our I's and cross our T's on this. The most mistakes we see are people are just writing checks, not even holding the meetings, not even having a rental rate comparison or anything like that. So just make sure you're avoiding that. The next thing I want to talk about is meals. And so meals deduction are 50% deductible, generally stating 50% deductible is going to be a meal expense. Now, entertainment, no longer deductible. After the Tax Cuts and Jobs Act, they removed entertainment expenses, but meals were still allowed. And so I always tell people, get creative here. As a business owner, we are constantly talking about our business. Every time we go to lunch, every time we meet with people, we're talking about our business. So if you're talking about your business over a meal and it's ordinary and necessary for your business, let's make sure we're taking a business deduction for that. We're taking a pre-tax spending. So when I talk to business owners all the time, I say, well, how many times did you go out to eat this last month? So I went 6 times, with my sister, my friend. I also met a client and different things like that. I said, how many of those did you run through the business? Well, just that client one. I said, well, did you talk to anything business with your sister, with your family, with your friend, whatever it might be? And they say, well, yeah, actually, my friend, I was asking him about this hiring situation I was going through, and she gave me some advice on that. She actually said that she has some referrals for me, so she's going to refer some friends over to my business. And I said, well, you didn't take that as a business deduction? No, I was just eating lunch with a friend. I said, well, you talked about business. You just told me the majority of your conversation was about business. And they're like, oh, that's what I get it now. And so this is this idea of meals deduction. How can we make the most out of meals deduction? Now, the mistake that we see people make is just not even thinking about it. They're meeting with a friend talking about business, but they just say, well, it's a friend, so it's not a business deduction. Think about it. What is this discussion doing? Write on the receipt, who did you meet with? Why did you meet with them? Write on this receipt who it was. Now, don't do this for every meal. I always say, a lot of times maybe my spouse will go out for a nice dinner, have a meeting discussing business and all those things like that. And we'll take a business deduction for that. But if I did that every time I went to dinner with my spouse, the IRS would say, your spouse, first off, probably ain't going to be your spouse much longer if you're talking about business every time you get a meal. But then also think about we want to be reasonable with this item. So that's meals deduction. The next item I want to talk about is travel related deductions. Travel is basically when you're away from your principal place of business. So you're away for overnight from your principal place of business. And when you're traveling, you can get a deduction for the rent car rentals, Airbnbs, hotels, plane tickets, meals when you're traveling. Even if you're traveling solo, meals are still deductible when you're traveling. And so that's the cool thing about travel and I always say, let's get creative about travel. Of course, if you're going to a conference or whatever, that's a business deduction. And the travel, what it took to get there, what you did there to maintain that place, the hotel, everything else you were doing, those are all valid business deductions. But I start to talk to business owners, I said, let's get a little bit creative about this. You want to take your family to Disney. Is there a webinar? Is there a seminar? Do you have clients? Do you have vendors down there that you could visit with? And in order for a day to be considered a business day in the IRS eyes, the majority of the day has to be spent on business. And so they look at a business day as 4 hours and 1 minute. A business day is 8 hours, so the majority of the day would be 4 hours and 1 minute. If you spend the majority of the day on business, 4 hours and 1 minute, that's considered a business day in the eyes of the IRS. Now, they don't care what you do after that, whether you go to the beach, whether you go to the amusement park, whatever you might do after that, they don't care, as long as the majority of that day was spent on business. So I always say, when you're traveling, be strategic. Is there a conference or a workshop or a seminar that you could be going to visit in this place that you want to go? Is there a client, a vendor, an employee that you could at least make a portion of that trip a business deduction? So get creative around the travel piece as well. Some of the biggest mistakes we see here is that business owners just not thinking about this, not documenting it, not planning out that way that they can turn travel that they're going to do anyways or want to do anyways into a valid business deduction. The next tax strategy I want to talk about is automobile. And so this is things like your personal automobile. This would be car, trucks, motorcycles, those types of things. And so we always want to be thinking about, where am I utilizing an automobile for business purposes? Now, you might have, if you're using a vehicle, 100%, like if you're an electrician and you have this work van, obviously that's 100% business deduction. But maybe you're a consultant, a media consultant, and you have a truck or a car that you have, and you go to client meetings and stuff like that. But the majority of that use is personal use. We want to be thinking about the automobile deduction. Are you taking mileage at the very bare minimum for the business use of that vehicle? Are you utilizing an accountable plan to reimburse yourself for the business use of a personal vehicle that you're using for business? And remember, we talked about home office, and we talked about maybe you have other offices. Well, if you go from your home to an office, or you go from your home to another office, that's considered a commute. That is not deductible mileage. But if you go from one office to another office, one office to a client to another office, those are all deductible business miles. Now remember, we talked about this home office, and every business should have a home office in some sort of way. Well, now if you go from your home, which is your home office, to another office, that's deductible mileage. You're going from an office to another office, assuming you did your administrative work at home in the morning, went to your other office and came back, that's deductible business mileage. Your commute in that instance, turn from your bed to your home office, no mileage there. And so automobile is a great opportunity. Track your mileage. Now, the biggest mistake that we see people make in automobile, they have no mileage tracker. They're just kind of making a blanket statement of, okay, I drove 1,000 miles, so that's what's going to be. We have people that will maybe take, not looking at the actual method, which is just a mileage method, or the actual method, which is where we take all the costs associated with that vehicle, depreciation, gas, all those repairs, maintenance, all those different things, and take the business use percentage of it, or mileage, which is just a set mileage for the business use of it. So the biggest mistake we see is people just not documenting it. They're utilizing this vehicle all the time, but they're not documenting it, and they're missing out on this very easy thing to do is track our mileage, make a reimbursement for it. If you want to go the actual route, if you're over 50% business use, now we can look at the actual method and see if we can maybe use depreciation, all different sort of things to really amplify that business expense. The next thing we want to talk about is retirement planning. Now, retirement planning is something that small business owners unfortunately sometimes put on the back burner, and they miss out on. And they think, well, my business is going to be my retirement plan. But what happens when you go to sell that business and it's not worth anything? Because that business depends on you, and it's not really worth much without it, or it's not worth as much as you thought it would be. So for those business owners to say, well, my retirement plan is me selling my business, I say, why not fund a retirement plan in the meantime? Get some tax benefits from that. And hey, if your business sells for a great amount down the road, well, now you just have a retirement plan as a cherry on top. But if your business doesn't sell, you have that backup plan. You have something to lean on. And so when it comes to retirement planning, there are all sorts of options. If you're a solo business owner with no employees, you can look at a SEP IRA or a solo 401k, depending on how much money you want to put away. If you have employees, you can look at a simple IRA or maybe a safe harbor 401k, whatever it might be. The biggest thing, as I say, is if you have extra money to put away, think about funding it somewhere, somehow into a retirement account. And it's going to depend on how much do you want to put away. If you're saying, I just want to put $4,000 away towards retirement, that's all I can afford right now, just look at a traditional IRA or a Roth IRA on the personal side. If you say, I want to put away $20, $30, $40, $50, $60,000 in retirement planning, well, now we might be looking at a solo 401k or a safe harbor 401k for your business. And so the biggest mistake that we see people do is, first off, not doing any retirement planning for themselves, but also if you don't have a retirement account, it's harder to retain employees. It's a great benefit for your employees again. But the other mistake that we see is people just in the wrong retirement plan. They have money to put away, but they're not in a retirement plan that allows them to do that. The next tax strategy that we want to talk about is hiring your kids. Now, this is one of the most powerful and often underutilized tax strategy that is out there for business owners. And the concept is this. You're supporting your kids in all sorts of ways. Whether you're sending them to basketball camps, whether you're paying for this entertainment, this amusement park that they want to go to with friends or whatever it might be, you are constantly supporting your kids. But traditionally, you're using after-tax dollars for that. So again, with our concept of saying, hey, how do we turn money that we're already doing, that basketball camp, that amusement park, we're already spending that money, but how do we turn it into a business expense? Well, we can hire our kids in our business. We can have our kids do work around our business. Now, they got to be doing actual work for our business. We need to document what they're doing. We have to pay them a reasonable rate. And we have to do all those different things. But here's the beauty behind it. As we hire our kids in our business that are under 18, as long as we're paying them through a sole proprietorship, we pay them, we get a business deduction, and they potentially pay no income taxes on that. Business deduction, our kids potentially pay no income taxes on that. If we pay them under the standard deduction, they don't have to pay any taxes at the federal level for that. And if we pay them off a sole proprietorship, they don't have to do Social Security or Medicare, FICA taxes either. So if we pay them our kids out of a sole proprietorship, we could literally receive or get a business deduction. Our kids pay no taxes at all on that income they received. This is a beautiful benefit and a beautiful way that we can shift that income while also helping our kids understand this idea of working for a living, understanding the family business, and maybe getting involved at a very young age into this idea of running and being a business owner. So it's a very powerful strategy, again, that I think every business owner with kids over the age of 7 should utilize in some sort of way. Now, some of the biggest mistakes that we do is we see parents not paying them out of the right entity. They're paying their kids out of an S corporation when they could set up a family management company to pay them out of there. We see them paying them for rates that don't even make sense. They might be paying them maybe too little when they have the ability to pay them more, or they might be paying them too much. They might be paying their kids $500 an hour to cut lawn. Well, that doesn't make sense. Other mistakes we see is we see business owners not documenting the hours, what they're doing, the job description, all those sorts of documentation that we need to put in the strategy to dot our I's and cross our T's. Regardless, hiring our kids is an incredible strategy. The next strategy I want to talk about is a capitalization policy. And this comes around when we're buying assets for our business. So typically, if we buy an asset for our business, think like a vehicle or maybe a piece of equipment or a computer, something like that. Traditionally, if we buy an asset, we have to capitalize it, put it on our balance sheet. We have to depreciate it, which means that we're taking that expense over time through a depreciation method allowed by the IRS, and we're going through those processes with it. And while all that's fine, the IRS offers what they call a safe harbor option that says if you have an asset that's $2,500 or less, you can expense it immediately. You don't have to worry about capitalization and depreciation. You can just take that expense on your income statement. Now, in order to do that, you have to have a capitalization policy in place, and you have to make the election on your tax return. So I always say every business owner should have a capitalization policy in place so you don't have to mess around with this. Now, this limit, instead of $2,500 and it be now, it used to be $500. So you go and buy an iPhone for $700, you got to capitalize it, and you got to depreciate that iPhone over time. You don't get the expense right away. You might get that expense over 3 years, 4 years, 5 years, depending on the type of asset that you're purchasing or more. And with this capitalization policy in place, now we can get that expense all together, all in year one, all right away. Now, the biggest mistake that we see is people just thinking that they can just utilize a capitalization policy without having those documentations in place and without making that election on their tax return. So they'll just be like, oh, just went and bought a new computer for $2,000. I'm just going to expense that. But they didn't have a capitalization policy in place. So that's not allowed. Make sure you have a capitalization policy in place on file, and you make the election on your tax return to indicate that. And now you can say, okay, any item under $2,500, I'm going to expense immediately. And I will do that for every item. Any items over $2,500, you still got to capitalize and depreciate it and do that the normal way. Now, no, this is per item. So if you go to Walmart and buy 2 computers for $4,000, $2,000 each, you can expense it immediately because it's $2,000 for one computer, $2,000 for another. Even though the total transaction was $4,000, because each individual item on there was only $2,000, you can expense that immediately under a capitalization policy. The next tax strategy I want to talk about is a health savings account. This is a strategy, again, every business owner should have a health savings account. Every individual should have a health savings account as long as you qualify. In order to have a health savings account, you need to have a high deductible health plan. So if you have a high deductible health plan, you can have a health savings account. And what is a health savings account? Basically, it's an account that you can utilize to pay for medical expenses. Now, the IRS, this is one benefit that you very rarely see with the IRS, where you get a deduction going in, you have tax-free growth and tax-free withdrawals. And that's how a health savings account works. You get a tax deduction when you put money into an HSA, a health savings account. That money, when it's inside that HSA, grows tax-free. And when you take money out to pay for qualified medical expenses, you pay no taxes on the withdrawal of that. That's the beautiful thing about an HSA. Now, a lot of people say, well, Mike, I don't contribute to an HSA because I'm healthy. I don't need money in that health savings account. And I say, well, you're healthy now, but wouldn't you maybe, at some point in your life, probably going to run into some type of medical costs that you're going to have to pay for it? And wouldn't you rather use tax-free growth and tax-free withdrawals to pay for that, especially when you got a deduction going into it, when you do that instead of using taxable dollars? And they say, well, yeah, that sounds great. And so I think I tell people, think of a health savings account as almost like a secondary retirement account. It's something you get a deduction going in, a great benefit, tax-free earnings, and tax-free withdrawals. You don't see that in any other vehicle that the IRS offers. And so I say that as long as you can afford it and you have a high deductible health plan, everybody should be using a health savings account. So those are some of the tax strategies, the write-offs, the different things that we talk business owners through. Now, we're just kind of starting to scratch the surface on the opportunities that are available to them. But I want to go through some of the risks. And I want to talk about some things here. First off, so many people spend so much time learning about things, which is important. It's important to learn about tax strategies, but learning doesn't provide any tax savings. It isn't until you implement a tax strategy that you get the actual tax savings. So you could learn about everything. That's not going to save you any money. You could watch this video 10 times. That's not going to save you any money. You have to take what you've learned and actually implement it. That's where the savings comes. The implementation piece is where you start to see those tax savings. And that's exactly why we built Tax Helm, is because we want people to learn. We want people to know the strategies, but we also want to help them with implementation, which is why we have guides. We have full video implementation walkthroughs. We have downloads and templates that help people take that strategy. If we're looking at hiring our kids as an example, we have 5 example documents and downloads and templates that make hiring your kids possible. We have a video that walks you through step by step everything that you need to do, because we want people to not just stop at learning. We want people to complete that process and implement. Now, the next piece of that is correct implementation, because so many people will implement something, but it's implemented incorrectly and it's not valid. When we talked about earlier the home office deduction, how some people think it's risky. Well, the home office deduction is in the code, completely legal. IRS encourages it and wants people to utilize it. And it's completely legal. But if you implement the home office incorrectly, you can make it illegal. If you say that 99% of your home is your home office, well, that's illegal. And now you just took a valid business deduction that's available for everyone, but you just had incorrect implementation. You didn't implement it correctly, which means that you didn't create that to be a legal tax strategy. So it's important to not only implement, but have correct implementation. And that's what we do here at Tax Helm, is we have those documents. We have those guidance. We're here to serve as your source as a tax expert, that if you're like, I think I did everything right, but I just want second eyes on it. We're here to be that second eyes. We're here to help you make sure you have all the documentation on file. So I always say dot your I's and cross your T's. Make sure that you're understanding the strategy correctly and you're doing everything correctly to make sure that you're implementing it legally. Because you can take a tax strategy that in concept, in theory, is legal, implement it incorrectly, and make that tax strategy illegal. And so we need to make sure we're dotting our I's and crossing our T's. Have those documentations that support on file. Again, within Tax Helm, we have all the documentation support that you need to help back up these expenses. So if the IRS ever come knocking, you just, here's the documentation, here's the support, and they can run with it. Make sure you keep receipts on file. Write on the receipts who, what, where, when, why. You go out to lunch with a friend or a colleague, write on the receipt. Who'd you meet with? Why was it business related? Write on the receipt, take a digital picture of it, save it on file. You have that documentation. That if the IRS ever does come knocking, you have that documentation on file. The other thing we say, don't get greedy. There's so many strategies that are available to business owners all across the country and so many strategies that you can easily understand and implement. Don't get greedy on strategies. Do things the right way. Take full advantage of what's given to you by the government as an incentive, as a business owner, and implement it correctly. That's what our goal here is at Tax Helm. We're here to help you learn strategies, correctly implement them, have the documentation support to back them up, and make sure that you're doing things the correct way. Dotting your I's, crossing your T's, and again, our goal is to ensure that you're paying the least amount of taxes as legally possible. Now, to finalize things, you can now save thousands of dollars utilizing this full range of tax strategies and write-offs that we talked about. However, there are many risks to be aware of that we haven't been able to fully capture in this video. If you are looking for a tax savings blueprint, unlimited access to a team of tax experts, or a one-on-one annual comprehensive consultation, click the link below to get started.